we have Chris, the Daisy God, back with us. So hopefully we can have some good conversations. Chris, I don't know if you're able to watch yesterday. I know you were busy with work, but I basically walked through a little bit about what you tweeted yesterday about M2 money supply and
Hmm.
talked a little bit about my concerns with it. I looked up a Yahoo article and the fear of deflation and what that might entail. And some people were really excited. They were like, oh man, you mean I could wait a couple months and be able to buy something for $1 cheaper? It sounds pretty good. But if you think about the whole cycle of business, not that good, right? It might sound good
Yeah.
for you if you have a lot of cash on hand, but not good for the people that are making all the goods and everything of like. So we'll get a little bit into that today. I didn't notice it until you poked me. I don't know what the fuck is going on with oil. It's spiking about $3-4 over the last looks like couple of hours. So I don't know if you got any insights about that. The cool thing I did see on the Wired Home is a cruise vehicle, driverless vehicle. It's a ghost fucking car driving right next to me. And I was like, oh my
Hmm.
God. I was like, there's no driver in that damn car. And I noticed it had all the gear and stuff on top. And I'm like, there's no way. I'm like, is that really? And then I pulled up on my phone. Of course, yeah. Like over the past week or so, we started getting some cruise vehicles here in Houston, and so I'm curious what that's going to do for, say, like food ordering slash whatever. But I didn't realize it was even coming because last I heard it was still in Phoenix and San Francisco.
Hmm.
And then what was the last thing? Oh, NEXT. I saw and read up a little bit about the Rio Grande LNG project and how they're starting to get financing for that. And I'm curious because I didn't dive too much into the financials, but big project, man. Like I think the first
Hmm.
phase is supposed to be 17 MTPA, which that's bigger than most people's portfolios in general. I think Shell's portfolio is something on the lines of like 25 or 30 MTPA. So if you think about it in that perspective, this one project is going to be pretty huge. Keeping in mind NXT is not going to own all of it, but it's a good starter position and will drive a lot of value for everybody involved, whether or not it's a prudent thing to be investing in. Maybe that's what we'll discuss later today. And then if we get to it, that's a lot already. But
Yeah.
NextEra Energy, which I'm an investor in, and I will probably be buying more of, did take a big dive today. NextEra Energy Partners took a way bigger dive, like 20%, 21%. And so we could touch a little
Hmm.
bit about that, maybe some headlines, but maybe not go into it if we find the time. But that's a lot to cover in an hour.
Yeah.
I've been
Yeah.
talking for 2.5 minutes, so I'll let you chit chat. How you been?
Good, man. Just sorry I couldn't make it yesterday. I feel a little bit at fault because I shared some data, but I didn't share it like completely. But I get a chance to do that now, so I'll do it. So this right here is M2 money supply relative towards inflation. And pretty much you can see here since like let's 80 years might be a little too far back. But 50 for the last 50 years, you can see here the correlation behind inflation and M2 growth is pretty pretty consistent. So usually you'll see like these crosses happen, whereas M2 money supply tends to go up. Eventually, the inflation values they eventually catch up and they start rising as well. But then also when M2 supply starts to go down, you also see the correlation happen with inflation as well. So this is where I'm keeping an eye on M2 money supply right now because they're in they're pretty much linked together. And I think a lot of what we're about to see is this rapid move towards deflation because a lot of that M2 year over year supply growth rate has gone down. And this is like in a long time has gone negative. Like rarely do you ever see like it go negative. Like let me see, in like 100 years, I don't think it's ever gone negative. Yeah, it's never really gone negative. I mean, there's been bouts where it's gone somewhat close to negative, but never negative. And this is the first time it's gone negative. So be interesting to see what ends up happening. So you can see here, inflation, like the M2 started to grow. And then after that, inflation was just coming down. It's there is a correlation here where there is a delay, but this delay right here is going to be worth watching to see how this is actually impacted going forward. So, you know,
Yeah,
so
this is a big change considering I think like a couple I don't know if it's 2 weeks ago, but we talked about it, and I had to ask you to clarify, or I was confused, and I was talking about, are you talking about deflation? You said disinflation, but now you're actually thinking that deflation is a potential risk.
Yeah.
And I know that Elon was talking about that months ago, 6 months ago, where he was really concerned, and I think that he probably was one of the first few people that I know that were really bringing it up from that perspective. And so for people that aren't, I explained it a little bit yesterday, but I'm not nearly as intelligent as you, and people like it when the Desi God explains things. So explain to me what deflation means to you in like layman's terms, right? I think everyone knows it's like if you have a dollar, that dollar is going to be able to buy more over time. But what does that mean in terms of like the business cycle, the impacts and the follow on? Because everyone was like, "Oh, cool. So if I just keep this $1, the money I've been keeping under my mattress for the last 10 years is finally actually going to be worth something instead of losing, 10% of its value every 5 years." What does that actually mean? Instead of it being worth, let's just say, 90 cents on the dollar, it's now going to be worth $1.10. But what's the business implications of that?
So the key here is that when you think about inflation, inflation is not bad in but it's only bad if it gets past a certain amount. There's natural rates of inflation which are actually good for the economy. That means that there's actually being progress being made, right? You don't want a situation where you have flat year over year. Like I know some people always say like, "Oh, well, 50 years ago the cost of a movie ticket was only $1 and now it's this much money, and so inflation is bad, like they had it so good back then." But then you also have to remember that that's all relative based on the time frame that you had back then, right? So the key right now that we have to look for is that we want inflation, but we don't want it to be more than like 2%, 3% at the most, because after that all sorts of really bad things start to happen, and then they feed themselves. Like worse things starts to happen. When you want economic growth, you want just a little bit of inflation so that your economy grows, the money supply grows, and more people are able to transact, and the value of a goods and service goes up over time, right? Um, Disinflation just means that when you've had a period of higher inflation or even regular inflation and things start to calm down again. So, like, let's say last year prices went up by 10%, and this year it only went up by 2%. That's disinflation. That means that last year there was 10% rise, but this year is only 2%. It still means that there's inflation out there, but it's much more controlled at a level that's a lot more acceptable. So that's the key to disinflation. Deflation is prices going down on goods and services. So whatever you were charging last year, let's say $100 for a product, this year it ends up being, let's say, $90. Now, for consumers, it may feel good, like, wow, this is great. But for the business owner who's got costs that are associated to last year, that's bad. And what also happens now is that you have this environment where consumers will generally hoard cash because it'll be worth more tomorrow than it is today, right? So if you have a natural level of inflation, like a little bit, it entices people to go out and spend money. But if you have deflation, it causes people to hoard cash. And if people hoard cash, that means that money is not being circulated in the economy and it's not growing anything. So imagine right now, and this is the scenario that I laid out. Imagine three people, me, you, and a third person. I buy a good and service from that person. They buy goods and service from you. You buy that good and service from me. So we're all happy. We're all, our economy is working. But let's say I stop spending because I'm like, oh, maybe next year Matt will, I'll get a little bit of discount from Matt. So if I don't spend my money, then the guy ahead of me doesn't get any money, and the guy ahead of you doesn't get the money. So now you already have all your liabilities set and you invested based on those liabilities. Now you have to cut back on your spending. And now whatever I was selling ends up not being sold. So you see how that kind of like destroys that whole wheel. So the key to what the Fed is doing right now is by raising inflation, raising interest rates. So it makes capital more expensive, right? So people think twice about, supposedly, people and businesses think twice about spending additional money and additional capital on more speculative things. And so that provides this almost like hurdle that businesses have to cross over in order to get financing. So if your business is only making 5% return 2 years ago, there would have been a lender to let you borrow that money, because they still would have got their 2% interest or 3%, whatever, and you would have had a healthy 200 basis point margin. So if you had a high, revenue business, you were still able to make money. But on the other hand, now it's not like that. The bank is not going to lend you 5% and your profit margin is only 5%. Now your profit margin, if you had the higher capital cost, would end up being zero. So you see
Mhm.
how higher interest rates almost act like a hurdle for new business investment, and also for existing businesses not to invest further in different things, whether that be hiring people, spending money on, acquisitions, spending money on, capex to build more factories and stuff like that. So this is the key towards what we're undergoing right now, which is we're in a inflationary cycle. So in order to control inflation, the Fed has basically raised interest rates. And what's happening now is that the interest rates have gotten really high, really fast, to the point where there's all sorts of things breaking in the general economy. In my opinion, shelter is probably the worst thing that's broken right now, because right now, if you look at the price to own versus the price to rent, the entire script has been flipped. But also at the same time, there's very little to no inventory out there in certain markets, which means the people that are selling their homes, they're able to exact a higher price, and thus causing inflation to get worse. So this is all like, in my opinion, a s- a negative downside to the, not that I disagree with the Fed in raising interest rates. It's just that speed at which they rose those interest rates did not allow the consumer to get used to these natural rises, right? And also, I think some of it might have been an overreaction. So, in their initial calculation that this was likely to be a transitory event, in my opinion, was probably true. But when they saw those prices rise way fast, they couldn't stop, and they just had to react. Whether that be because of political reasons or whatever, they just had to do it. So I mean, you remember what the causes of inflation were, right? Like the main causes of inflation in 2022
Yeah, I
and
mean, oil
2021.
oil price went from $70 a barrel to $130 a barrel within the
Hmm.
matter of a couple months. Natural gas prices went even worse. I think it was
Hmm.
like $3 an MCF, and in the US, it went all the way up to $8, $9 an MCF, so almost 200, 300% X. In Europe, it was even worse than that. So you think that we had
Hmm.
bad inflation here in the United States, peaking out. Some people say it was 13, some people, but I guess the marketed number was really 9 year over year percentage. Uh, it was even worse. Like I think it was in Europe due to the gas prices being such a huge impact, and a lot of businesses actually had to shut down because they weren't actually able to use or pay for the gas prices. So that, and then obviously that has a trickle down effect on all your costs of other goods, like your input
Hmm.
items or transport costs, which obviously plays into a fact of margins. But before I guess, move back it to you, you said two things with respect to when you were talking about deflation. Take a company like Walmart, which
Hmm.
specializes in volume and not necessarily margin, right? So they
Hmm.
might only be making 2 cents, 3 cents off of every sale for every dollar that they sell of commerce or anything like that. Uh, and now, if you're in an environment where you're in deflation, that company is essentially losing money every time they make a sale, because by the time that they put the costs in to be able to buy it, it's going to basically deflate so much that their margins are going to go negative by, let's just say you have a 5% deflation or what have you. Now, for every cost of whatever they're selling, they're losing 2 cents instead of making that 2 to 3 cents that they were. Versus if you're on the inflation side, kind of like what you're saying, you have that active kind of movement going on, and what you're buying today, eventually next year is going to be worth a little bit, or it's technically going to be worth a little bit less, but it kind of keeps that cycle in motion. The other thing that I think that you said, it's like, imagine today if you just had like 10 grand and you're like, man, I really want to go have fun and do X, Y, and Z. But like, imagine if you just sat on that 10 grand and it was worth 11 grand equivalent, just because you were eating a sandwich instead of going out to buy lobster or something of the like. It's like everybody would just be staying at home eating peanut butter and jelly sandwiches, waiting for their cash value to go up instead of going to buy new cars or anything like that, because You buy a new car, that car might be cheaper, in terms of the amount of the nameplate value of what it was in, say, several months, just because of this deflation period. So nobody's buying cars, like you said, and it kind of just the musical chairs kind of stops in that
Hmm.
perspective. And so I think that you did a really good job explaining that, but I just wanted to highlight those particular two things that to me really rings a bell. Is like, you said it perfectly. If all three people, me, you, and Amit, are buying something and we're trading amongst each other, he's buying fruits from you, you're buying burgers from me, and from Amit, you're buying, I don't know, bananas. I don't know. And
Hmm.
one of us decides to just stop, we're all going to starve, right? Because he doesn't want to eat
Hmm.
bananas every day, and everything like that. So I thought you did a pretty good job with respect to that. But
Yeah.
I took it back to the
And
deflation, and
yeah.
you're trying to move it on
And
to
this
oil
is where
prices.
and this is where we have to take into consideration, like, what solves that issue. The issue gets solved usually by government intervention or the Federal Reserve intervention, where, let's say, I don't buy from you, Matt, right? And our economy is now broken, right? We're in this death spiral. But what if the government comes in and says, "Hey, Matt, I got an idea. Why don't I lend this dollar to you for super cheap? I know Chris didn't buy from you last time, so why don't I lend this to you?" So now what do? You have this additional dollar that now you can use to finance yourself. And so now when I do start to say, "Oh, look, Matt got a dollar. Hey, let me borrow a dollar, Mr. Government," right? And now I have a dollar. So now I can go and I can spend $2 with Amit. Amit spends $2 with you, and you spend $2 with me. So you see how now our economy just went from $1 to $2. So it's driven by a lot of debt also. So the
And
more
that's
money that's in
effectively
circulation.
what you're describing is basically the stimulus package that we got in
Yeah.
2019 and 2020, right?
Yeah.
Everyone
So
was
when you
kind of
introduce,
afraid because
yeah,
of the pandemic,
yeah.
and they were kind of afraid, oh, the economy needs to keep going. What they do, they gave everybody $1,600 multiple times or whatever it was. I didn't
Yeah.
get any of that, but
Yeah.
I know people that did, and they were excited about it. And they invested it all in GameStop, but and I
Mhm.
lost money. So anyway, but yeah, I mean, it's exactly what you're kind of describing, and I don't think we really ever think about the ebbs and flows of the M2 money supply like that, but it
Yeah.
is kind of crazy if you think about it, and it tells you everything you need to know.
Yeah. And so we're undergoing right now this dramatic decrease in M2 money supply. So there's not there's this decline of money in the general market will naturally mean things start to slow down. What we have to do as investors is not try to hit a bullseye, but imagine right now it's almost like a moving target. We have to try to hit a moving target. Right now, everyone is concerned about oil prices, right? And I'm going to tie this right back into oil prices. The time to be buying oil stocks and ENG companies and was not yesterday. It was a year ago when the price of oil was only like $50, $60 a barrel, right? Who would have guessed that the Saudis were gonna, cut production, and the Russians were gonna cut in production at the same time and drive oil prices higher? Well, most people back then, if you were a contrarian, you would have said, "Yeah, that's a good idea because you know what, the Saudis can't afford $50 oil, so eventually they're gonna try to do what they have to do to get oil back higher." So the Saudis being marginal producers, I mean, it's logic, it's common sense that the Saudis would want to do that, right? So if you made the bet like you did when you bought oil stocks earlier in the year, you would have made good money right now. ExxonMobil is up a lot. You know, the worst thing you could do is try to chase the market now and say, "Look, the oil prices are higher. Let me buy all these oil companies because they're gonna do exceptionally well." And that's not to say they won't do well. I think a lot of them are still very undervalued. They're trading in like the single digit PE range. But dude, let me tell you, last year was the best time, would have been the best time to buy oil and natural gas stocks. Not, you know what? I take that back. Not necessarily, not natural gas, because natural gas prices, by the way, if you looked, have not gone up. It's only oil that's really gone up. So there's actually a bifurcation of those two. Um,
Which I'm really surprised about, because I understand why the second half of last year, with Freeport LNG going down and having that fire, if you remember, they weren't exporting a lot, and they were one of the biggest LNG exporters to Europe. So to us, that meant, and then it's the same reason why from 2012 to, or maybe it was 2010 to kind of like the I guess more recent past, gas has been below $3 an MCF because we have so much plethora of it. If we don't export it, we have too much, and if we have too much supply, obviously, the price of it's just going to go down because you can't keep up the demand. Now that you're trying to balance, and we'll kind of get into the Rio Grande LNG and stuff. Now that you're trying to balance the demand for the natural gas in the United States plus what you're shipping off to Europe and stuff of the like, that's where you start to see that increase in prices again, hopefully closer to the $5-6 range. But I'm honestly just surprised that we haven't gotten to a place yet where natural gas prices are back on the rise.
Yeah. So if you look at this, this is natural gas prices here in the US. This is Henry Hub. This is not the Dutch. So basically, we in the US are awash with natural gas. We've got natural gas coming out the demon hole. Like, we're lucky that we have that. So our spot prices for natural gas on a global level are some of the cheapest in the world. We have access to a lot of cheap energy, which is, believe it or not, great for us. Our economy is powered by cheap energy. Any economy right now that gets powered by cheap energy, that means that that's less input cost per total output of production. Because at the end of the day, one of the key components to production is energy, right? Whether you're using it as whether you're using it as like a fuel source to keep the lights on and everything else, or they're using it for transportation and and heating and everything else. So right now, our cost of production compared to, let's say, the Japanese and the Europeans is much lower thanks to our energy abundance. So anyone that says, the US doesn't need energy abundance, like we need to all, like that doesn't matter, bro, you're completely lost. Like, no, one of the reasons why the US economy is one of the best economies on the planet is because we have a plethora of energy that we can tap into cheaply. So let's take a look. This is Henry Hub prices. So last year, when all the stuff happened with Russia, you saw natural gas prices skyrocket here in the U.S. as well, primarily because a lot of those cargoes were actually making their way to Europe because there was just huge amounts of spread that you could got. But now natural gas prices have pretty much even bottomed out. They're pretty much at the same level where they were around, like, right after COVID, like probably a little bit pre-COVID, right? So these natural gas prices are really, really good for us here in the US. Now, one of the keys to natural gas prices, though, and a lot of people don't necessarily take this into their calculations, and this is one of the areas where I think we had a lot of issues with food prices. Now, people don't really correlate natural gas prices to food prices because they think, oh, what does natural gas really have to do with that? But one of the keys to modern farming is the use of industrial fertilizers that are all nitrogen based. And the way that you synthesize those fertilizers is by using natural gas as a feedstock. So let me just show this to you. So if you look at this, this is the price of fertilizer right here. This was on the Patreon, of course. So you can see here, let's go to 2021. So 2021, you can see fertilizer prices, they started to really spike up, right? Around October, in which case they just went bananas. And then all throughout 2022, the price of fertilizer, so all those seasons of planting and feedstocks for livestock and everything else, they were at much higher elevated prices than typical 5-year average. So you can see here, this gray line is the 5-year average on fertilizer for anhydrous fertilizer prices. The key here for 2023 is you see this dramatic drop in fertilizer prices. That means that now one of the biggest input costs of farmers and farming is going down, which means now the next season and the season after that, you're going to see a lot of farmers able to actually sell and produce at lower cost, which means that lower cost will eventually make its way to us here in the United States, right? And also around the world. So this is the key. If you look at the urea prices, which is fertilizer prices, you can see here that they spiked significantly last year, and that spike is actually making its way back down again. So food prices are now correlated downward, and you can see here the price of food Last year, the inflation rate was close to 10%. Now it's actually gone down. Like food at home last year was almost 14% inflation. Now that's gone down to near zero. So the prices last year are the same as what they are this year. Now, the consumer, of course, is probably saying to himself, dude, 5 years ago, I was only paying X money for eggs. Why am I paying more? Well, the thing is, inflation, last year's prices are what they are this year's prices, and that's typically, you don't really see that happen where it goes downward, right? You're seeing though some parts of inflation cycle actually trend lower. So if you look at food away from home, that actually went down in price, probably because there's probably some discounting, competition, and everything else. But for the most part, food prices have genuinely moderated to like a flat number. And so if we were looking at it from the lens of an inflation person, you're going to see that inflation costs are actually, food inflation is basically flat, which is helpful to the average consumer. Now, does that mean that consumers are in a better off position? I don't think so, because if last year things went up by 10% and this year they only went up by, let's say, 1 or 2%, that doesn't mean that, that's a good scenario to be in, right? It just
Yep.
means that, this year is not as bad as last year, but it's worse than we were 2 years ago. So
Right.
that's the same thing that you can say about housing as well, where right now they're like, well, the year over year price of housing is is flat now. But if you look at it 2 years ago or 3 years ago, they're like 40% higher than what they were three
Mhm.
years ago. That's bad, you know.
Yeah.
So a lot of this stuff is all about figuring out how this actually unwinds now. And there's two ways that it can unwind. One, we go into disinflation, which means that the price of things remain flat for a longer period of time, so that this way prices eventually catch up. So if you take it from an average perspective, if let's say something went up by 30% in 1 year, right? And then the 2 years after that, they went up by 0%. What happens now is that at year three, the price only went up by 10%,
A year.
on
Yeah.
a year. So then if you extend that out even further to 10 years, right? That means if it's the same price as what it is after year one, that means that you only grew inflation by 3% for that specific product.
Right.
So that's the key to disinflation, and that's what the Fed would like to see, which is we've had higher rates of inflation. We want to see that prices moderate and actually come down slightly. There is another thing that can happen, and this is the scenario which no one wants, which is the hard landing scenario, which is the price of things actually go down, right? So if last year things went up by 10% and this year they went down by 10%, on average now you're going to see a trend
And you've
that's going to
seen
be
that
much more
for some
flatter.
items, like eggs have come down, but eggs
Yeah.
I think was a perfect storm, right? You had all the costs and everything in terms of food was going up in price, but there was
Hmm.
also the supply impacts with all the fires that were happening in the egg industry, and I think a lot of sickness as well. And
Bird
so
flu.
the
Bird
yeah,
flu.
bird flu, and so chicken wing prices skyrocketed as well. Now it's kind of come back to normal, right? You had to have a second
Hmm.
mortgage on your house just to be able to afford eggs in the morning. And now you're actually getting back to a place where it's not too bad. $3-4 for a dozen versus it was like $9-10 for a dozen, right? Almost $1 an egg. It shit's out unheard of. So some things will come down in terms of like back to normal. But if you notice like chips and stuff like that, they still are up, 20%, and they're not coming back
Yeah.
down. And I anticipate that that's just Pepsi and everybody just moving the cost of goods down the line. And like you said, it might be something where it stays flat here. And I always try to relate it back to a bottle of like 16, 20 ounce soda. Because like I remember when I first started going to the store, it used to be like 79 cents or something like that to get one when I was like really young. This is probably close to 20, 25 years ago. 5, 6, 7, when my memories actually start catching up with me. Now you can go to the store and it's like almost 250 to get one of those damn things if you go to like a 7-Eleven or anything like
Hmm.
that. So if you think about it in that perspective, it's like you're going to have years where it blows through. Like a Monster Energy drink, I think when they first came out used to be $2. Now they're 350. Like,
Yeah.
and I'm talking like 2008, 2009 when Monster Energy first started coming up on the scene. So like even that over the course of 15 years has almost gone up, 100%. And so if you think about it in that perspective, I mean, it's 5-6% per year. But I
Yeah.
anticipate, I think a lot of them were staying under 299 up until more recently because of the pandemic. And I think that they took this opportunity with inflation to catch up. And they'll probably
Mhm.
stay at 350 for a little bit, right? Just like you said, right? That
Yeah.
disinflation of, things coming back to the norm. And eventually I'm sure that there'll be some sort of event where they move it close to 375 or to $4. But it's at 350 now for a Monster
Mhm.
Energy. But anyway,
And it
but
also comes down to businesses being able to extract higher amounts. Like rarely do you ever see vendors ever say, you know what, I know last year the price of this candy bar was $1.50. Let me lower it down to $1.25. And that's not to say that that is the cost at which Hershey's is supplying the gas station, but that's the gas station saying, look, my other costs have gone up too. So
yeah,
I'm going to make sure that I have a higher cost. And also from a margin perspective, they get a higher margin, right? So if they can get the same product for a cheaper price, that means that they make more money. There's no real incentive to take the prices down, especially when consumers have the money and the ability to actually spend that money. It's not there's no business is in a hurry to lower prices unless it's like competing away their profits, right? Like if they keep the prices high and consumers are not willing to pay for it, then they'll start lowering prices, they'll do discounting, they'll do coupons and everything else. The thing that we really need is competition. Like the more competition that's out there, the more likely it is that the sellers will end up lowering prices. So imagine a
yeah,
gas station, there's only one gas station in one area, they can extract 20-30 cents more per gallon than a exit that has 5 gas stations around it,
all right,
right? So the more economic activity there is, it tends to work in the favor of consumers. Now the key that we have to just take into consideration is what are some of the growing input costs that are happening right now that throw this entire equation completely out the window. And of course, that's all there's pushes by the unions right now. And like the federal government's kind of, stepping in a little bit and supporting the strikes. And so you're seeing multiple unions right now using this opportunity of higher inflation to extract long-term fixed guaranteed raise contracts for their members. So right now inflation is at, let's say 4.5, 5%. They can go to their employers and say, look, we want every year for our employees to get a 4% or 5% raise for the next 5 years.
mhm,
Now, let's say inflation goes down and we only have inflation at 1% or 2%. Those workers are still going to get a 5% raise because that's
right,
what's agreed upon in the contract. So a lot of these unions are moving while they have the opportunity to get as much as they can. The problem that tends to happen, though, is that if everyone moves at the same amount and everyone's wages start to go up, you typically run into the issue where now inflation is kind of just built in because now the assumption is that every year inflation is going to go up by 5%,
right.
right? So that's not good
Well, it's
either.
the same argument, exactly what you're talking about with respect to the minimum wage stuff, right? Where people are trying to raise it to $20 and on the West Coast. And I'm not saying that it's not prudent to do so, but like you're kind of talking about, it's not prudent to go from an $8.50 minimum wage to a $15 overnight, right? Because you just increase that person's minimum wage by 100%. And so now they're effectively feeling great, they're able to spend more, but it kind of raises the floor for everybody else. And if that floor raises, exactly what you're saying, then that's just going to cause underlying inflation for everybody.
Yeah.
Me, who's a skilled worker, had to go to 12 years of high school plus a graduate education, not graduate, but I guess undergraduate education, and like slaved away in the libraries at night to be able to get my specialized degree. It devalues that to an extent because my employer is not going to increase my wages 100% overnight. I think I got a 4% raise or something over the course of the last year, and so that was under inflation, right? If you look at it for the full year. So if you think about it in that perspective, it's like that person now has caught up closer to me, and that disparity. So if you're forcing something like that, like these union workers are trying to force themselves to get tens of percent per year, and like UPS and stuff of the like are trying to get tens of percent per year, It makes for really funny memes when people put it on Instagram and stuff of the like. But in reality, I'm not saying that these people don't deserve more money, but at the same time, you need to be prudent about making sure you're not running away with some of these things. And some of it's some of it is just really good negotiations by the unions, but I think also some of it is just making sure that people become a premier company that people want to work for. So it's a double-edged sword, because obviously if you're too stingy with the money, people are going to leave. But if you're too freeful with the money, your company might get into some sort of issues in the future where you might have to cut staff because you're not having as much margin to play with to keep kind of staff around during bad times. Or it's just gonna to kind of, they start pulling back on some of those things. They're gonna be like, oh, we used to get 10% raises, now we're only getting 2 to 3%. What the hell's going on? And so it's a double-edged sword all around. But it's just a kind of crazy world that we live in with respect to like people not truly acknowledging some of these things. And I get why they might be fighting for certain things in certain areas, but you have to recognize is like, now the floor is $20 an hour for minimum wage, and you can't go back to $7 or $8. And so if that's the case, then everybody else's wage has to go up accordingly, or things are just going to get more expensive at the bottom.
Yeah. I mean, this is one of those things that's going to be a challenge for the average person to figure out, because you want a populace to have, and this is me just speaking as a person who's trying to be on the more economical side of things rather than personal level. But if you have all the poor people, let's just say poor in the like the lowest working class of the people, if you give them $20 as the base, then that means that they didn't become rich overnight, or they didn't get more money overnight. They didn't become middle class overnight. They're still poor. The problem is because everything else in price is going to go up. So anyone that gets like a $15, $20 an hour job now, that is the minimum expectations. Now, the key to financial independence, of course, is to just make sure that with those higher rates that you have assets that you're investing in, which make up the difference between your living costs. So your fixed costs should always be maintained. So I know right now, if you and I'll give you a story about when I was growing up. There was my dad. We lived in a 2-bedroom brownstone, like an apartment in a brownstone in Brooklyn. And there was a neighbor of mine who literally they owned the townhouse. Right now, they were making the same amount of money roughly as my dad was living in an apartment. This guy was there, but their kids would go on vacations all the time. They would have great time. They would enjoy themselves. They'd do all the stuff that they wanted to. And the reason why they were able to do that is because the guy had inherited that townhouse from his father. So those kids, the cost that which he had to basically hurdle over was very small compared to what my dad had to, because my dad had to first pay the rent, pay the food and everything else, where this guy didn't have any rent, didn't have a mortgage. All he did was have this property tax that he had to knock out. So one of the keys to like wealth over a long period of time is just making sure that you buy your own place to live in. If you get that portion covered, like right now, Matt, how much money do you spend on rent, if you don't mind me asking?
It's like 2,400. Yeah.
2,400, right? Which is reasonable, right? But that means that every year you're paying 2,400 times 12, which ends up being close to almost like what, like $2,800 roughly speaking, right? So
$28,000.
$28,000. So if you multiply that, $28,000 is your hurdle rate to life, right? So if you don't make more than $28,000, that means that you're starting at zero, right?
Yep.
Whereas let's say you owned your own place, like you free and clear, you owned it. Now, even if you worked a minimum wage job, you could live the same life that you're living right now, because at the end of the day, there's no hurdle. The hurdle is much lower, right? So this is one of those times where right now we have to figure out how to lower the hurdles for people so that they have more income to do other things. I think one of the tragedies that I hate the most when it comes to us is the lack of ability to own a home is becoming harder and harder for people. You have all these corporate interests in the housing market bidding up the prices of a lot of homes and a lot of Airbnbs and all this other stuff. And so the price to just live is going exponentially higher. So right now, if you're in New York City, $2,800 is like the minimum you need for a one bedroom apartment, which means that every single minimum paying job out there, you could not survive in New York City, unless the minimum wage was bumped up to like $20. So now everyone's pushing for that $20. But at the end of the day, most of that $20 is going towards who? It's going towards the person who owns the building, that basically that person is living in. Whereas if the person was able to afford their own home or at least have rent that was much, much lower at, let's say, $1,000, that means that's more money that person has to do things with, like, to spend on discretionary items,
Mhm.
not going towards making the wealthy even wealthier,
Yeah,
so.
I was going to pull up. I couldn't find the right graphic. Basically, the divergence that you're talking about with respect to housing prices at the moment and rent,
Mhm.
and rent was getting out of control last year to an extent where I think a lot of places raised rents by 10 to 15%, but it's fallen off a lot. Like what
Yeah.
they to answer this gentleman's question about why I don't buy a home, I think I'm in their underwriting process at the moment. So by the end of the month in October, I should be moving into my new place. But the thing that is probably not really apparent to people, and Chris is kind of referring to, is like even if you do get a mortgage and it is a little bit tough for you to pay, it might be a couple $100 more a month than rent. Think about the fact that yes, you might still have property taxes that increase over time and insurance that increases over time, but that underlying, let's just say you get a $2,000 mortgage, and mine will be about 2,000. That's not including taxes, insurance, and stuff of the like, but just $2,000 mortgage. About that $2,000, that's going to be a $2,000 mortgage for the next 30 years, right? Until I pay off that or I pay ahead of time and stuff of the like. But that's not going to change. And so one of my thought process is this isn't necessarily going to be my forever home. If I end up dating some chick, she's going to want me to buy some house that's worth 600, 700 grand. So to me, I'm just buying a small house that I know for a fact in the future I'm going to rent, right? It's a small
Mhm.
3 bed, 2.5 bath. It's 1,500 square feet. It's going to be big enough for me. And so the thought process is like, and there's a whole roundabout way of stories, and we can get into it at a different time. Or if Chris is really curious, I can talk about it. But I didn't buy a house for a very long time. And in retrospect, I forget it or I regret it. But I didn't do it for a reason, and those reasons wouldn't have changed even in retrospect, right? So while I'm upset I didn't get to buy the house and been building equity all this time, I did it for a reason, and those reasons were, I think, really good reasons. Because to be very frank, it could have ended up in a scenario where I was having to travel a lot for work. I did live in Trinidad and
Mhm.
Tobago, and I didn't have that lockdown of a house, or I actually was in discussion about moving to the UK before the pandemic, right? So all these different things that I honestly thought were going to happen didn't end up happening. So
Yeah.
leaving that there, I'm buying this house, $2,000 mortgage, rented out. I think right now the estimates are probably anywhere between 2,400 to 2,600. It's not a lot. I'd probably lose money if I rented it out today after taxes, insurance, everything the like. But 5 years time from now, majority of those costs are going to stay the same, and I guarantee
Mhm.
rents are going to go up by 4 or 5% every single year.
Yeah.
So in 5-10 years time, rents are going to be 28, 2,900. Now we're getting to the point where I'd probably break even, make a couple $100 a month. I'm not going to
Mhm.
be filthy rich, but that's something that I looked at. And another thing, and I don't necessarily want to make this a show about real estate. I have the capital in a savings account that I've been having for a little bit. I get bonuses, stuff of the like. I just shuffle off of every paycheck, and I've been having more cash just because you're actually getting paid something for it now, as opposed to literally nothing like you were
Mhm.
um, over the past 2-3 years. So now the fact that you get 4 or 5% on your money is pretty nice. You don't have to invest and take on risk to be able to get it. You just literally let it sit and you get a little bit. Of course, you're not going to potentially make as much money, but it's also a lot less risky or risk free depending on what you're doing. I looked into the difference between putting a 10% and a 15%. Now, some people are always, I hear people talk about this all the time. They're like, oh, but PMI and this and that. It's like, okay, cool. PMI, like I think you know where I'm going with this, right? Like, okay, do you want to wait another several years, saving up your money till you have a 20% down payment? And it's like now you have, let's just say, for example, in a primary residence, an additional $40,000, depending on your house, that you had to come up with. Think how long it's going to take you versus just buying the house now and paying an additional 50, $60 a month for private mortgage insurance. It's like,
Yeah.
think about that return. It's going to cost you, let's just say $500, $600 a year for the private mortgage insurance. Or sorry. Yeah. It's a private mortgage insurance. Why am I getting it? Anyway, PMI, whatever the fuck PMI means.
Yeah.
And instead, you're sitting there being like, oh, no, I need to get 20% down because I don't want to pay PMI. You're losing the forest through the trees, right? So, like,
Yeah.
think about that. And the way I looked at it was I had an ability to put down 15%. I'm saying, you know what? I'm going to use that 5% for the next rental property. So instead of putting it down on a primary residence, which I'm going to probably live in or rent out in the future, I'm now getting a jump start and spreading another 5% into the future, you know, and so I might only be paying another 100, $150 a month. But to me, that's more meaningful because if I do lock in that second or I guess this would be the third property for me, then I'm probably going to be getting a couple $100 a month in equity pay down anyway. So I'm getting that jump ahead, even though I'm paying a little bit more up front. You know, it's $150 today. It's $20,000 I don't have to invest in this damn house. And I have that $20,000 that I just have to get another, say, $40,000, and then I can buy the third property. So that's kind of the thought process that I had around that. But I don't know why I went down that path, but somebody asked about the housing. So
No. I mean, I think, in my opinion, I think housing is going to be a pretty lousy investment for the next 10 years. Not for living purposes. If you want to live in the house, it's going to be fine. Like, don't take, don't think me, Chris, have gone bare on the housing market. But what I think is a lot of that increase that we saw has to make its way throughout the general economy. And the way that happens is one of two things. Either we're going to get a housing crash, which I don't think is going to happen because credit quality is just too good for people. Like, unlike the last time when we had housing loans being assigned to people, who couldn't afford them. And they were a lot more adjustable rate mortgages back then. Now we have a completely different scenario where it's all about duration right now. So I think housing prices will end up being something that trade like in the 1990s. If you go to like 1991 to like 1999, housing prices only went up by 2% per year, which is like right in line with inflation, which is fine. Like that's what you typically want to see because that's how the general populace tends to benefit, right? And you as an investor, you can benefit because you're getting your equity is still going up by 2% every year. So if you're paying let's say 5-6% mortgage, and you're getting a 2% interest that you're paying out of that, but the equity is more than covering it. So you have inflation of the price of the home is going up at the same time. There is a profitable way to make that whole scenario work. So I think housing will only go up by like 2-3% per year. So in terms of like a total return, I think it's better to be in something like equities. And even certain times, I'll be honest, like right now I'm looking at some preferred equity in some office properties that is just trading so low. I just can't. They're dirt cheap for the amount of return, and there's capital appreciation behind it. I'll
preferred,
take it
like
all
preferred
day.
stock or like
actually, I'll send it to you. I'll send you the data for it.
Yeah, I know that you and I were talking about it, and I'd be curious. But to highlight what you're talking about, right? Like people saying, "Oh, well, I'll just wait till housing gets cheaper." It's just like, look at it; it rarely gets cheaper, right? I know this isn't going back for 30 years, but here you can see, it rarely goes below the zero line, right? This is annual price increases. Yes, this big spike up in 2021, but I mean, just look at it. It's like steady, 4 or 5% per year, depending on what you're looking at. And this dip, I think, was really just because of the housing crisis, and it really, you didn't even see really things bottoming them out till the 2011, 2012 timeframe. And this was spotty too. Some areas were down 20%, other areas were up. And I think it's going to be very similar, nationwide, right? I think a lot of places, like Austin, you see that the value of Austin went up really huge. Same thing with like Idaho. A lot of places that people really wanted to move to, all those places are going to get hit the most, and those are the ones that are probably going to actually see price decreases the most. But I would say from 2022 to 2023, I've been watching a lot of houses in Houston,
Mhm.
and I would say it's normalized, right? I wouldn't say that things are continuing to get cheaper and cheaper and cheaper. Um, it was at the point where I think people were trying to catch things at the end of 2021 throughout 2022, and people were having to cut very aggressively. Now I think it truly is like people are saying, and I'm keeping an eye on it because I have been looking for property. I think it honestly is getting to the point where things are starting to get back to, uh, you know, the supply just isn't there, and so people are being able to get a little bit more. But my thought process is, and maybe I know you wanted to mention the 10-year rate, and then also we have NEXT if you want to dive into that too. But quick thought, because you're more attuned to this than I am. Do you think that when rates go down, that there's going to be a lot of people running to buy and that will cause housing prices to increase? Or do you think because rates are down, that also means supply will also increase because people are actually more willing to move? Or do you think it's going to be a double-edged sword where people are going to be like, ooh, well, I want to make sure I have a contingency on the mortgage, because a lot of people I've seen are doing contingencies as of late. They want to make sure that they have the right house first before they
Mhm.
get out of this other one, to make sure that they don't get stuck holding a 7-8% mortgage when they could just be having a 3 to 4% mortgage.
I
So
think
some quick
it's
thoughts on that.
I think it's all about inventory, right? Housing inventory right now, because of just a lack of people really wanting, really selling their homes. Let me just bring it up 1 second. So if you look at this, if you look at the active listings here in the United States, like on a seasonal level, like this is going back to 2016,
Can you
on
zoom in on that a little
average.
bit?
Oh yeah, sorry. So right here is the active listings, right, for housing. So if you go right here, there's about 1.4 million active listings in 2016. And you can see here over time, things usually go up and down. This up and down is typically seasonality.
Yeah.
People don't necessarily want to move during the winter time. They don't want to sell homes during the winter time, and they're not looking to buy anything during winter time. So usually the list of active inventory tends to go down,
You know
and
why
then it
that is,
starts to
Chris?
go up. Well, school,
Yes.
because no one
I was
wants to
I was
move.
wondering. I was like, huh,
Yeah,
curious with this guy. Yeah, it's
yeah.
definitely cool.
Yeah, no one wants to move their kids from one place to another, especially middle of the school year. So typically, a lot of people, if they're going to do listings, they typically start listing them in the spring, sell them in the summer, and then end up buying around the summertime as well. So you can see the active listings kind of like fluctuate. So you can see here the number of homes tends to fluctuate up and down, up and down. But what we saw after January of 2020 is this huge drop in listings, right? Um, we thought that, what, over time they're going to catch up, but thanks to the Federal Reserve and them just lowering interest rates as fast as they can to combat inflation, you saw in inventory start to decline again. Now you're starting to see inflation starting to climb, and I think if we look ahead at this graph, I think what we're going to see is eventually the return back to an active inventory list of about 14 to 16. 1.4 million to about 1.6 million homes. And because there's so much pent up probably demand, there's probably a lot of pent up inventory that is going to be sold in the future when when rates are down and people are looking to move. I think that's going to cause a lot of inventory to spike, and that will end up keeping the price of most homes actually relatively flat compared to like a giant crash, in which case the price of homes will all come down. So I think when the Fed starts lower rates, like right now the Fed's interest rates are about what, like five, is it 5.25 right now?
Yep.
When they go to, let's say, 4.75, that means that there's going to be people that now with the lower mortgages looking to buy, but there's also going to be people looking to sell because they want to buy as well. And then the year after that, let's say it goes down to 3%, there's certain people who are going to want to buy and certain people who are going to sell, so that inventory is going to come back on. Also, there's been a massive amount of construction, so there's a lot of
Yes.
inventory that's coming online. That's why rent prices have pretty much flatlined, because there's
Yep.
just so much construction out there. On top of that, you also have immigration to, like, whether that be illegal or the other migration. So there are a lot of challenges that I see happening with housing. But if I had to make a prediction, I would say that housing prices will probably track a 2% inflation target for the next 10
Okay.
years. That would be my estimation.
And if that's the case, I mean, going back to what Chris was kind of talking about, it's like I know there's property taxes, insurance, and stuff like that. You're going to have to pay through something like that, even if you're renting. But the thing that I think is most prudent to think about, like take for me, say my house does only grow 2% annually, right? I only put down 10%.
Matt, not to stop you, just one
Yeah,
second, real quick, because I think this is a point that I should have made before. Everything depends on regions as well.
very
So I
true.
think
Yep,
what I did right now is just say 2%, but I'm talking about nationally. Now, there are going to be regions that have higher levels of economic development, which means more people are going to want to move in and the price of homes are going to go up. So, like Matt, you are in Texas right now. Texas is like the final destination for everyone. Like
a lot
everyone
of people.
wants to move to Texas. So
Florida,
the
yeah,
price,
all those
yeah,
places.
the growth in prices in Texas are nowhere near the growth rate that you're going to see in other parts of the country. So I would say Texas would be a ideal place to buy a home. So let me just preface that real quick. Sorry about interrupting you.
No, I think
Go ahead.
you're right. I mean, it goes back to where people want to be and where jobs are, right? Like, and
Yeah.
now that people are unfortunately or fortunately, depending on how you look at it, have to go back into the office. You know, I know a bunch of people that I work with at UDoc. They ended up buying houses in Montana, and they were like, "You're coming back to the office, right?" And you're like, "No, I moved my entire family to Montana, and sitting here in Houston, Texas." Like, oh shit! But you have to think a lot of medical industry here in Houston, a lot of oil and gas industry, a lot of financial here. One of
Semiconductors.
semiconductors, one of the biggest ports in the world is here in Houston. So a lot of economic activity that'll drive people. And same thing with Dallas. Dallas has a lot of financials as well, a lot of oil as well. So
Mm-hmm.
there's a lot of value in there. And Austin is heavy into tech. Uh, Google has a beautiful headquarters that they built a couple years ago, and I
Yeah.
anticipate Amazon's there as well. But and a lot of fintech in Austin as well. So they're every city in Houston, or sorry, every city in Texas kind of has their own little niche that they always try to follow. But what I was kind of trying to say is, Chris is talking about that 2% annually. So let's just say you're uh, fortunate to be in that 2% bucket. If you only put down 10%, you have to think that 2% isn't an increase on the 10% that you put down. It's an increase on the home's value itself. So you're
Mm-hmm.
leveraged 10-1 in that respect. And so if your house price goes up, say, $10,000, well, or sorry, 2%, let's say you have a $100,000 house, you put down 10%, you have $10,000 in equity, and it goes up to $102,000. It's like, well, shit, like you didn't just go up on your money, say just 2%. You went from having $10,000 of equity to $12,000 of equity, which means you went up by 20% on your money. And so think about it in that perspective as well. It's like almost, Michael Saylor talks about this a lot. I don't want to make this about Bitcoin, but he talks about it a lot. It's like the best thing that you can do is own real estate without having any money into it, because it's almost
Yeah.
guaranteed to go up with inflation. It's like, yes, you'll have some years where it might not, some years it will, but if you own that asset, you can at least transpire through time, or go through time and make sure that that holds value, right? And
Yeah.
some, like you said, some places will appreciate better than others, but on average, you'll be able to hold that. And so if you think about it, it's like, say you put down 1% on some of these homes, it's like, well, that's probably not smart if house values do go down, and you kind of have to be forced to potentially refinance or something like that. You won't be able to, but technically you'll get a lot larger of a return on your cash. But keep in mind, if you're just taking that other 9% and blowing it, it makes sense if you're taking 10% and you're putting it across 10 different homes, right? But if you're only buying one house 100%, then you're only going to get 2% return. Anyway, different story for a different day. Chris,
Yeah.
do you have time to talk about NEXT, or do you want to wait for another day?
Maybe we'll wait to it for another day.
Okay.
There was one comment in the thing that said Disney's coming to Texas. Actually, it's Universal. I don't know if you saw that.
Is
It's
it
going to be a
reversed?
giant Universal Studios. Like, hold on, let me just show you. There's a giant theme park that's supposed to be coming to Frisco, Texas, I think.
Okay. I think
Uh,
that's near Dallas.
yeah.
I can't remember.
So yeah. Yeah, it's gonna be interesting to see like all the development in Texas, man. Texas is already one of the largest economies, but I think it's gonna lap California. You know.
Yeah, it's north of Dallas. You really
Yeah.
think Texas is going to lapse California?
Oh
I think
yeah.
there's
Oh
going to be
yeah.
that much of I know there's already been a lot of people that exodus, during the pandemic because of everything that was going on, political changes, all that sort of stuff. But do you think that's going to continue to transpire, and why?
Yeah, mainly because Texas has such a business friendly climate. Like, as long as that business friendly climate stays like that as a core part of like Texas, you're gonna see a lot of people move there. The way that California right now, in order to do one thing, takes like you ask any business survey, the business friendliness in California, and it's like it's not there. So a
Hmm.
lot of capital is moving flight from California to Texas because Texas has a lot of the benefits that California typically had in terms of like logistics and everything else. So that's why companies are moving there. That's why Elon Musk moved, headquarters, not headquarters, but he moved production over to Texas, and also the proximity to Mexico, which is another developing economy. Maybe that's something another topic we can
I
talk
think
about
people
in the future.
underrate the shit out of that, man. They're
Yeah,
growing really fast. I would actually love to buy some. That's the problem, is like being an American, you can't technically own property. You have to own it through somebody else or something like that.
yeah,
I would love to own a property in like Tulum or any of these other developing resort beach towns that are kind of just getting started. And I think
yeah.
Central America on its own, Belize is blowing up really quick, and I think
Hmm.
uh, just Mexico in general. It's something I've actually thought about because I've seen some people on the internet like basically this industry of being able to buy cheap land and put some resort like homes on it, and they're still cheap but relatively compared to the cost to build them and the lack of regulation and stuff like that. Not to say that they're crappily made homes, it's just it's you don't have some of these excess regulations that you have to put in, like some of these things. For example, my family does a little bit of contract work and does you know uh, if you build a home from scratch now in Pennsylvania, you have to put in some cistern where it can capture water because they're so developed now, I guess, in the southeastern part of the United States. They want to make sure that there's not water just running off into the streets down to the sewers. They want to make sure that it's like actually absorbing back into the land and all this sort of stuff. It costs like 20 to 30 grand to build those things, right? They're not cheap.
Hmm.
And so you have to factor that in to any time you're now wanting to build a house from scratch in Pennsylvania. And so what a lot of people are now doing is flipping because they don't want to pay that 20 to 30 grand worth to build a cistern, which adds zero value to the house. Like you build a cistern, it's not like it's going to add, 20, 30 grand value to the house. It's just a cistern that doesn't actually add any bathrooms or any fireplaces or square footage. And so that sort of stuff can be a drag on economics and just an economy. And so I was like always asking, I was like, why aren't people building more houses? And I was like, well, I'll tell you why. And so I was like very, very confused because my family went from building, a couple houses a year. And now they go to strictly just flipping, which I thought was
Hmm.
pretty interesting. I don't see any of that money. I don't know where that money is, but I wish I knew. Um, but maybe one day I'll see it. Who knows? Um, but yeah, that's eventually where I want to kind of head into. Is just one or two houses a year, something that's enough to kind of keep you busy, but not anything that's going to stress you out too much.
Hmm.
You get a one or two phone calls a week that you have to deal with, but other than that, you're not stressing
Dude, you know
yourself
what?
out.
You know what I want to do? I want to buy a giant piece of land with an amazing view of something, and just put like these platforms and fucking some tents on it, like canvas tents,
Yeah,
and just rent that shit out on Airbnb.
Yucatans. Yeah,
Dude,
they're
like
like
me and the
600,
wife,
700 bucks, and you could
huh?
like they're like
Yeah.
600, 700 bucks as Yucatans. Yeah,
Me and the wife, we tried this place called Camping Under the Stars in near the Grand Canyon. It was a really nice experience camping. Let me just show you what it looks like under the stars. I mean, this could not sleeping under the stars. This could not have cost more than maybe a few $1 million to develop. And I'm sure that they got their ROI in like a year. All it was is just a giant plot of land. near, hold on one second, like near I think it's called Under the Campus. Yeah, it's right here. It's like a lot of people like glamping. Do you know what glamping is?
Yep. Yep.
So this is what it looks like basically. It's just a tent in the middle of the like, like a really nice place. And you end up sleeping for four people. There's multiple beds, there's like a little water thing there. But the cost is like very little. And if you think about how much it, like you can book it for, let's just take a look real quick. Okay. So
Sometimes they're 150, $200 a night, if not more,
yeah.
depending on the marketing, right? If you have really good marketing, some people will charge you $700 a night for that shit.
Yeah. Look at this. 279
Yeah.
for in Arizona. And this is freaking like wasteland. Like
Yeah.
prices around here is like probably super cheap.
Yeah.
And
That's the
so
thing.
you can get a place
I
like
look out
this.
in like
Yeah.
Terra Lingua, which is like West Texas.
Yeah.
And like when you think about Wild West, like cowboys, desert for
Hmm.
days, that's what you're thinking. It's probably the same thing for this part of Arizona too. But
Yeah.
it's like if you find a little bit of trees, you have a little creek running through, some people just go out there to just get lost, right? And you could
Hmm.
buy acres for 50 grand, like
Yeah.
hundreds of acres, maybe even part of a mountain. So you can do some of this shit where it's like you put 40, 50 grand into it, develop it a little bit, and next thing you
Hmm.
know, you have this cash flowing asset. And that's one of
Yep.
the things I would love to get involved in. But you have
Yep.
to find a place that like will it eventually grow? Does it matter? My buddy SG in here, he was looking at like Joshua Tree a couple years ago, and now that's
Yeah.
absolutely exploded. So yeah, it's interesting. Like that is truly where that's a lot of risk too, though, right? Because like you say they're like, oh yeah, I turned this $50,000 piece of property, now it's worth 2 million. It's like you had to have the vision and execution,
Hmm.
and you also had to see that a demand would be there. Otherwise, people are going to be like, yeah, it's a sick house, but I'm not going to come to visit. Like, why the hell would I go X, Y, and Z, right? So you
Yeah.
have to have the marketing and stuff behind it. Anyway.
Yeah. No, I think, like I said, this is Airbnb's opened up a lot of possibilities for like experiences. I think people right now, they're willing to spend money on experiences that you normally wouldn't have, liked back in the day. Like I think of it
Mhm.
right now, bro. If I can go glamping for like a week, have my, have like a Starlink connection so I get high speed
Mhm.
internet, bro. I don't mind. I would love to be in a camp, like go camping for an entire week, stay
Get
connected to
lost.
work, and just get
Yeah.
lost for a week.
Yeah, can you imagine like if you have a campsite, let's just say 10 of them, but they're so far away from each other that, and then if you had somebody
Matt,
help
we
you
gotta find a spot. We gotta find a spot with a good view, with like nothing around it, with very
nothing.
little light pollution, and freaking just build something, and
That's
just live out
Terralingo,
there,
but it's
dude.
literally in the middle of nowhere. Terralingo
We
was
gotta
that,
get
but
there
that's more
before anyone
deserty.
else does.
But that's the
What
thing.
is
Do
it,
you want
Terra
more?
Lingua?
What's it? Yeah, Terralingo, Teralingua.
Okay.
Do you want somewhere that's more deserty or more like foresty?
I'd say probably deserty because that'd probably be easier to like build on.
Deserty's Terralingo. Yeah.
Ah,
That's
bro, we're gonna get killed by the cartels. This shit's like right across the fucking border. Screw
100%,
that
man.
nonsense, bro.
Yeah.
I'm not trying to get killed by cartels.
Uh,
Shoot. All right. Well, we'll figure this out. We'll figure this out. Eventually, maybe once we make all this money in our with our REITs, we'll do it.
That's what
We'll
I
get this
honestly
done.
thought about, like places north of Houston, because Houston, there's not much hiking. It's very flat. People are like, I need to get the hell out of the city, right? You
Yeah.
lose kind of like orientation about what life is and what elevation is if you live in Houston. And so I've always just thought like just buy something that's closer to a lake, put a couple like storage containers on it, and it might cost you a couple $100,000, but you're gonna have some sick cash flow in Airbnbs if you do it right.
Mm-hmm.
I don't know.
Yep.
I've stumbled into the Airbnb thing, and I think I have a very skewed view because we bought our house, and I was like, "There's no way it's gonna make this amount of money in revenue," and we've surpassed it by like 10-15%. I'm like, I still don't believe it. Like I'm still flabbergasted. Like, and everyone else is like, nobody's coming to our Airbnb, and I'm like, we're fully booked for October, and I'm like, it's the beach. Nobody's in the beach in October. Why are we booked? Like, I don't get it. We had
The
somebody
price is
book.
right, baby.
I guess, and I was thinking about this earlier because somebody booked for next June for 3 days for $1,200. I think it's 1,600 to them, 1,200 to us payout. And I'm like, man, if we fill out like some of these months here way earlier than expected, because we have like 2 or 3 other rentals for next year already for the summer. I'm like, I might have to increase prices even more because I increased them by $25 for
Mhm.
next year. And I'm like, I might have to increase it a little bit more because you don't want to get 100% occupied, right? Because
Yeah.
you'd rather have a little, knowing that you have a little bit of wiggle room, right? A little bit of price control. Because if you're 100% occupied, this is something I found out with SG because he did a little bit about this as well with Airbnbs and stuff. Is if you're 100% occupied, you don't know how much money you left on the table. Versus if
Yep.
you're 90 to 95%, you're like, okay, like I'm kind of in my
Yeah.
sweet spot. I'm
Price
getting,
discovery. You're trying to get
yeah,
good price discovery.
exactly.
Yeah.
So
Yeah.
if you're always kind of staying in that 90 to 95%, you at least know that you have a little bit of excess. But if you're at
Yeah.
100%, you're like, well, did I leave $50 a night on the table? Did I leave $25 a night? Was it
Mhm.
$5? So I'm kind of trying to find, like, we fully booked out this year. Some months, like from June to August, it was just, actually even through September, it was pretty crazy. So I'm like, next year, throw $25, a 5% increase. And I'm
Yeah.
sitting here like waiting for people to just gobble it up. Because if we get a few left, I'll be like, maybe an additional $25 for those remaining
Yeah.
slots. You never know. So
Yeah.
that's just going to
Yeah.
buy more properties, man. We're not taking any distributions. We're just putting all that money in the bank account. And it's nice
I
to
like
see.
I like what I like what SG says. You need the trifecta: airport, attractions, and amenities. That's
Yeah.
perfect. It's
Well, that's the
close
thing.
to a coastal. Yeah.
That's my
Yeah.
buddy. Him and I were talking about buying something and putting like a lake on it,
Mhm.
like a man-made lake. I don't know if you could find like a
I don't
natural
know
spring
about
somewhere.
that.
No, no,
Nah,
not
I
for
mean,
you.
there's plenty of spots that have lakes already. That
That's
I
true.
think. I think for me, I think for me right now, you want to try to keep as much natural beauty as
Mm,
possible with like amazing views. If you can find land that has amazing views, that's close to an airport, that has or close to a population, like a city center, like a
mm,
population density area, that could be perfect, man. The problem with man-made stuff is that eventually nature has a way of like taking that shit out. Like
yeah,
if you let's say made a man-made lake, I don't know how long that lake would end
true.
up surviving,
Yeah,
you
and it's
know.
got a lot of
Whereas
maintenance.
if it's something natural, yeah.
Hey, I
If it
have
was
another one
natural,
for you.
yeah.
Another one for you in the same
Mhm,
lens, right? And I know you're probably itching to get out of here, as am I. Um,
mhm.
like things like the Appalachian Trail. Think about that, right? Where people
Yeah,
always are
yeah,
going to need to stay, or
yeah,
then you have the Pacific Trail. You have all these trail
yeah,
systems within the United States, state parks that people are always going to try to visit. So that's another lens to kind of think about is like what state parks. Joshua Tree is a state park, right? That blew up.
yeah.
And then same thing with. I just went to the one in Tennessee. What's the one that's not too far north of you? Smoky Mountains. Yeah,
Smoky Mountains, yeah,
that blew up like 5-10 years ago.
yeah,
So it's like which one is it going to be next, right? Like, and try to, not that you have to forecast it, but get your little spot where it's cheap now. And it could be a cash flow machine. We have the Poconos, north of
yep,
where I grew up, and one of my buddies actually just closed on one, or he's either closed on it this week or he's closing on it this weekend, one or the other. And we're using him as a guinea pig because those houses are dirt cheap,
yeah.
but they cash flow insane. I don't think you're going to get price appreciation.
Dude, I
But
knew a guy who was commuting from the Poconos to the city. Like every
wow,
day, this dude would travel from the
to New
Poconos to the
York,
city, to New York City.
that's a far
He used to
drive.
work overnight. I think it's like an hour and maybe some change. But he
It's not
told me
that
that
bad.
since he was going against the traffic, it
Yeah,
wasn't that bad. You
yeah. If
know.
you take the Northeast Extension, you get through Wilkes-Barre pretty quick, and you get towards the city pretty quick. Depending,
Yeah.
especially if you're doing it at nighttime, that makes sense. But yeah, that's the sort of stuff like the Poconos. It's like it might not be a cash flow machine, but
Yeah.
you know,
So here, like this right here, like the Poconos Mountains to New York City, like right now would be about an hour and a half. So this guy, in order to one save shit ton of money, would drive 90 miles each way. Can you fucking
holy
believe that
shit.
shit?
I'm bad with geography, man. I don't know why I
Yeah.
thought that New York was so much more northeast. from
Yeah.
Allentown than it is.
Yeah. No, no. I mean, one of my cousins used to live in Allentown. Guy, he went every week. He would come to the city, go back and forth. So it's not that far away.
Huh.
So, you know. All right, guys. I am out. Next time we will talk about next. There's other opportunities we'll talk about as well. I mean, because I
Next and
think
next.
property, I think right now there are some really good deals in properties as well. So we'll take a look.
You mean the commercial
All right.
properties, or are you just talking about in general?
Commercial, yeah, commercial.
Right.
But not just commercial now. Like I know a property. We'll talk about it. We'll talk about
Okay.
it.
All right, my guy.
All right.
Good chat with
Later.
you. Take
Take
care,
care.
all.
Bye.